It's been a rough year for ChargePoint Holdings. The stock is down a little over 80%, but the stock is actually up 32% in the past month. So is there some sort of recovery happening at ChargePoint? Is the future getting a little bit brighter? That's what I'm going to dig into today and try to predict where this company is going to be in 5 years. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. Go to fool.com/ASY for their top 10 stocks to buy right now. First of all, let's look at what ChargePoint stock has done, and then I'll get into exactly why it's moved the way that it has. You can see here the ChargePoint, as I'm recording, this is after the market closed on Thursday, $1.76. So market cap of $748.5 million, up 32% over the past month. But you zoom out a little bit more, 1 year, the stock is down 82%. 5 years, shares peaked over $46 per share. During the pandemic, this was one of those SPAC mergers, so $10 per share was kind of the technical price that the company went public. But what exactly is going on with ChargePoint? And I think there's a few things. And I'm going to support this with the company's financials, because at the end of the day, you could talk about the growth in the electric vehicle market, the need for more EV chargers, all of this stuff. If it doesn't turn into revenue growth, profit growth, and free cash flow, none of it really matters. And so that's really the context with which we need to think about ChargePoint. Are things pointing in the right direction or are they not? The first thing I'm going to pull up is revenue and gross profit. Now, all of these numbers in this chart are on a trailing 12-month basis. So this looks back a full year with each of these numbers. You can see that growth was really consistent through the July quarter in 2023. Over the last 2 quarters, things have gone the opposite direction. The biggest reason for that is a decline in the number of chargers that are being sold. At the end of the day, ChargePoint is a charger sales company. Most of the company's revenue is made simply making chargers and then selling them to customers. Yes, it does have a subscription business and an ongoing business where it's building out its own network, it's providing services to customers who are installing some of their chargers, but that business is not enough to sustain the company right now. The vast majority of revenue is still from just simply selling hardware. So right now, you look at that gross margin number, and there's not a lot of gross margin in those sales. Last quarter, the gross margin was 19%, and that's on a GAAP basis, and 22% on a non-GAAP basis. That's just simply not enough to cover the company's operating expenses. So let's get to that next. This chart shows ChargePoint's operating expenses, the 2 biggest line items. R&D expenses is in blue, selling, general, and administrative expenses, that's mostly marketing expenses, is in orange. And you can see that $480 million over the past year in operating expenses. Why is that number interesting? The company generated $481 million in revenue. So ChargePoint is spending as much on operations as it is generating in revenue right now. That is a terrible, terrible place to be. And especially for a hardware company, that's never going to be a company that's going to generate 70, 80, 90% gross margins. There are software companies that can generate margins like that. So then they spend a ton of money on R&D, building out their tech stack, doing a lot of sales and marketing. That business model can work, but that's not the business model that ChargePoint is going to be able to implement. They're going to generate at best 30, maybe 35% margin on sales of chargers. So their operating costs need to be in line with that, and they're nowhere in line with that. And what this leads to is negative free cash flow. And that's exactly what you see here. Over the past year, negative $348.4 million in negative free cash flow. That is not sustainable for any company, especially not for a company whose stock price is dropping. And this is where you run into the fundamental problem for ChargePoint. When your stock price is really high, you can burn money and sell stock almost in perpetuity. But once your stock starts dropping, now your balance sheet starts to become really important. How much debt is on your balance sheet? Are you going to be able to raise more debt? Are you going to be able to sell stock to raise money? And this is the fundamental problem that ChargePoint has now run itself into. It's burning money on operations. It's acting like the stock is still at $40, $50 per share. And this is a $10+ billion company, but it's not anymore. And the balance sheet is starting to show a lot of weakness. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Here's a look at the most important items on the balance sheet for ChargePoint. How much cash do they have on the balance sheet? As of the end of the most recent quarter, $327.4 million. How How much debt is on the balance sheet? $283.7 million. And this is where you're fundamentally running into problems if you're ChargePoint. There's only enough cash on the balance sheet to last you about another year. So you're going to need more cash to be able to continue operations. How are you going to raise that cash? One way would be to sell more debt. With this level of debt on the balance sheet, there's not a lot of debt holders that are going to offer you any sort of reasonable terms on debt. Even the debt that is existing on the balance sheet probably trades at very distressed prices at this point. So really the only option to fund your operations in the future is stock sales. So you could sell stock for $1.50 per share maybe, but any sort of stock offering is going to be extremely dilutive at this point. Now, management highlighted on their recent earnings report that they don't actually have any debt maturing until 2028, but they also don't have enough cash to pay off the debt that they do have and fund operations through 2028. So this is really the problem that ChargePoint runs itself into. If the stock keeps falling, the options just simply run out for ChargePoint. That's the way that companies end up going bankrupt, is you run out of financing options. Sure, you can maybe lengthen your runway a little bit if you sell shares for $1.50, $1.50 per share, but all of those items are really dilutive. So what you need is the stock price to rise. The stock price isn't going to rise unless you start to grow revenue, grow margins, grow free cash flow, and those things are not happening in the fundamental business. And this is really the problem for ChargePoint, is this is not a fundamentally strong company. The thesis behind building chargers, building out this network that was going to generate growing revenue long-term just didn't work out. Now we're getting to the point where chargers themselves are becoming commoditized. Everybody's moving to the North American charging standard. That means that every charger is going to be able to charge every vehicle in the future, especially in North America. What differentiation do you have as a charging network if your charger operates exactly the same as the next company's charger? We've even seen this with some of the partnerships that they've rolled out, that they're basically white labeling their chargers. So there's no power in the network that ChargePoint has versus any other network. And so I just don't see how this company is going to be profitable long-term. I think something like building chargers belongs under one of the other big electronics component suppliers and conglomerates. They're going to be more efficient doing this. They're going to be able to price things and have a better business model. But ChargePoint, in 5 years, I am going to be shocked if this is still a publicly traded company. I don't know exactly what that means, if that means that somebody's going to buy them for some reason, or if they're going to have to go through a restructuring. But I don't think that this is going to be a publicly traded company, and I don't think this is going to be a good investment for investors long term. That's just the reality for ChargePoint based on the numbers, based on the trends, and based on the trend for the stock price. Sometimes these things are a downward spiral, and I think that's going to be the case for ChargePoint. But what do you think about ChargePoint? Do you think differently than I do? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.